Hey, good evening, everyone. Marty Mazzora here, January 31st, 2025, with your economic and markets end of week update. We will touch on inflation. We'll touch on markets. I'll ramble a little bit about the events of the week and try not to make it a marathon. So let's just start with the very interesting fact that our index, if you look at it, it's just a little sliver above zero. In fact, we came in with a score of 2.33, and it's the first time we've been in the green, the way we score our index, since August or so of 2022. A scenario where we needed to be thinking about recession risk and allocating accordingly. Now, this in no way, shape, or form gets us out of the woods. In fact, the reason we popped back into the positive today came by way of the Chicago Fed National Activity Index, and it went from the negative to a slightly positive 0.15, with 44 of its 85 inputs being positive, 41 negative. So it moved in terms of our scoring from negative to neutral. And that was the only improvement. There were several things that were borderline negative, but not enough to reduce the score. One that was interesting was the Baltic Dry Index. Now, this one's a tough one to score. It really depends on what you're looking at. So as you can see, 735, and by the way, this tracks the price of shipping goods across the world's oceans. And as you can see, we're down here at a level that we don't often get to, except when perhaps the economy has issues, right? So of course, the COVID recession, the scare in 2018, we had a 20% decline in markets, economic scare there as well. That mid-cycle slowdown in the economy, 2014 to 16, and then European debt crisis. So prices coming down amid global either recession, like back here in 2008, or concerns. The reason you wouldn't necessarily score that as a negative is because of the positives of the disinflationary aspect of it. But we do need to be cognizant of what it does say, and that essentially suggests that maybe there's less demand for shipping, and therefore the price is going down. And I think you could argue that maybe there's a little seasonality there, right? Here's the beginning of 2024. You can see it coming off of pretty high levels. The beginning of 2023, the beginning of 2022. Of course, that was a recession there, but you can see if you line it up right here at the beginning of 2019. So, yeah, perhaps we can chalk that up to seasonality. So we'll keep our eye on it. It didn't change our score. We're still sitting at neutral right here. So again, I thought it was dramatic enough to at least bring up and noodle on it a little bit today. I mentioned the inflation data that came out today, personal consumption expenditures. It's important because that's what the Fed supposedly pays the most attention to, and certainly didn't roil markets today. I think it was within the consensus range. Generally, the market discounts what the expectations are, and you get a move when it defies those expectations. So consistent with the Fed policy meeting and the message that they gave this week and so on. Typically, a Fed meeting, by the way, is something we would spend a lot of time on, but I can tell you, folks, markets are reacting much more right now to what fiscal policy, what the new administration may or may not do, more so than what the Fed is talking about. After this week's meeting, I will tell you that the odds of an interest rate cut got pushed out to June or July, where previously the odds were looking like we could have seen a rate cut in March, but the data is not suggesting that they need to right now. So staying on hold, until more data come in, makes some sense to us. The folks who are bullish on the economy, like MRB Partners, one of our research resources, believe that the Fed is probably going to have to hike, and they think that's going to be a big surprise to the markets. They're optimistic on the economy and optimistic, therefore, or you could say pessimistic in terms of inflation, meaning they think inflation is actually going higher this year. On the other side is BCA Research, another major supplier of research for us. They have the opposite view. They actually think that we could see a rate cut as early as March because they think the data will deteriorate more than what is currently priced into the market and what folks like MRB think. So it's fascinating to look at expert sources that are equally credentialed and talented and experienced, just looking at data and coming up with a different opinion. Of course, we have our own view as well, but we don't take anything for granted. We want to know what the smartest minds out there are thinking. And right now, it is a mixed picture by definition. Okay, so let's look at the technicals for equity markets just for a second here. And this is the very busy chart of the S&P 500, the daily one-year chart. And as you can see, we just continue to flirt with that all-time high, touched it again today, sold off heavily. We'll talk about the nature of the sell-off. I said we have these very notable divergences in momentum. Typically, that spells for what could be a pretty decent decline as this pattern kind of plays out. It recaptured the 50-day moving average. Looks like we're going to be testing that here right now. Monday is going to be very interesting, I think, based on Friday's news, which, again, I'm going to talk about here in a second. I'm thinking maybe we'll just take a quick look at the weekly and the monthly charts on the S&P. This is a 10-year chart. I can zoom in a little bit here, but first, just kind of look at how these patterns tend to play out. These rising wedge patterns on the long-term charts, and I like these. They're slower moving. You just have to wait for them to play out a little longer. But typically when you have these kinds of divergences, and it's a dramatic one right here as we go back to these all-time highs, you just have to kind of look out below for a while. The zooming in to get a little more concentrated picture here. Here's a 3-year chart. And again, each bar is a week. As you can see, pounding up against these all-time highs. And here's what those divergences look like. And that's a sell signal when the white line drops below the red line. On the monthly chart, here's the 30-year monthly look. Rising wedge pattern. No bearish divergence here. The momentum confirms the move and says it can go higher. However, the relative strength index definitely has a bearish convergence. We're at new all-time highs, and we haven't reached it in terms of that momentum indicator. And generally speaking, overbought levels on the monthly are somewhat rare. They seem to happen every few years, and they seem to resolve with typically something double-digit to the downside. This was about 30% peak to trough, just a little bit less than that. This was about 40%. This was about 60%. And this one was about 50%. So not saying that we need to worry about those kinds of declines, although I could argue, looking at valuations, that we need to be thinking along those lines. This is just an overbought pattern that, again, this was 16% decline in here, so that one's not so bad. But again, ultimately tend to resolve not so good. Doesn't mean it's going to happen that way this time. Just means we need to be aware of that signal. Just looking at the daily on the NASDAQ 100 index, this is Monday when it was reported that DeepSeek, an AI platform or engine or model out of China, essentially rivals what the likes of ChatGPT offer at a phenomenally reduced price. So that was quite the hit to NVIDIA. NVIDIA set a record on Monday. It was the largest loss in market cap of any one company in any one day in history. It was like $600 billion decline in the market value of NVIDIA. It went from the largest company to the third largest company in a matter of hours. And of course, that had a big impact here. So you saw the gap, and we've talked about how gaps tend to get filled. Sure enough, that gap got filled today right? But it didn't stay there. It actually came back down and closed negative on the day. And again, I'm going to get to that here in a second. Still have the bearish divergences, still a concerning look for the NASDAQ 100 index. The dollar, we've talked about this at length the last couple of videos. Right here, we said looks like the dollar is going to roll over. It did. Right now, it's showing us a bear flag pattern. If that rolls back over, that would be the dollar getting weaker, obviously. And the way the market's been trading of late, that would be bullish for stocks. And I also pointed to the 10-year Treasury, and same thing. We had a bearish technical look here, and I said if that falls out of bed, good news for equities. Then we had a bear flag pattern, said if that plays out, good news for equities, and it started to. And it found support here on its 50-day moving average. And this is the 10-year Treasury bond yield. I've been talking about gold each week, pretty good sized position to us. It's breaking out above all-time highs, closed right on that line today. We are very much gold bulls for the long term. Concerned in the short run. We do have these bearish divergences, so not the best technical look. Would not surprise me to see gold, not sustain these all-time highs at this moment. Ultimately, over the next few years, we think it's probably going a lot higher. Okay, so let's talk about today. So this is a one-day chart, and starting right here at the open, where you see the lines begin to jump around. The NASDAQ 100 index, the S&P 500, and the Dow Jones Industrial Average. So right off the bat, we had a real nice rally in the NASDAQ. It was up 1.5% from the previous day's close. The S&P 500 was up 81 basis points. The Dow, not so much. The Dow had components that actually were down on the morning. So the Dow was kind of sitting around the flat line relative to the close back here. This would be the overnight. So this is the cash session. So relative to the previous close, the Dow was pretty flat. These were having really nice moves, largely, due to Apple's better than expected earnings. I think Tesla was up nicely early in the day as well. Again, I've been talking about the negative correlation between yields and the dollar. Look what happened right when stocks rolled over today. The dollar shot up big time, as did yields. Yields came back down toward the end of the day. But as you can see, we had this reaction. Okay, so this didn't just happen all by itself. The White House, President Trump announced that tomorrow, Saturday, that they are going to move forward with 25% tariffs on Mexico and Canada and 10% tariffs on China. So this is when the announcement was made, obviously, and you can see the NASDAQ gave up, at least from the peak today, a not small, 1 2/3%, closed down 14 basis points. The S&P, again, here's where it peaked, was down 50 basis points. So it lost about 1.3%, and the Dow gave up, probably close to 1%. On that news, it's going to be interesting to see how this gets digested over the weekend. Remember last week, folks, my subject of the day or of the video was two paths that could lead to another 10% worth of upside in U.S. equities over the next few months. While those paths differed, both of them required either no tariffs, no new tariffs, or less and perhaps slower implementation of the tariffs that were promised on the campaign trail. What was just announced actually is significantly higher than the tariffs that were actually implemented in 2018. One day does not a trend make, short-term move, but I do think it is a signal, or at least representative of the kind of volatility that we can expect as we go forward. As I've suggested, we are in that camp that thinks that ultimately the administration does not want to do this on a long-term basis. I think over the weekend we may get responses that perhaps suggest that there's going to be a fight, and those would be retaliatory tariffs. And I think Canada has pretty much promised that if we go there, they're going to go there in a big way as well. And so no doubt the market's going to be nervous about that. So anyway, I think you get the point. January was a really nice month. Clients, you're going to like your statements. We held up very well Monday when markets really rolled over on that AI news. We just captured a fraction of that big decline in the NASDAQ and in the S&P. So chalk January up as a nice rebound from a really rough December. But as I've been discussing in every client review, let's expect a lot of volatility this year. We'll stay diversified, we'll stay liquid, we'll keep hedging, and we'll just continue to manage our way through whatever this world has to offer going forward. Folks, hope you have the best weekend. I appreciate you. Thank you as always for watching and listening, and I'll be back next week. Take care. Bye-bye.